Welcome back to Men and the City. In today's video, we're going to talk about financial markets and some warning signs that I think are really beginning to intensify, if not accelerate, all around the global economy, but especially in the US and the US stock market. So today's video is going to be called Entering the Speculation Danger Zone. I want to begin with a quote from Kenneth Galbraith to sort of explain the psychology of speculation and the euphoria that propels a lot of these markets completely out of whack with fundamentals and with what's actually happening in a practical sense. Quote, "The euphoric episode is protected and sustained by the will of those involved in order to justify the circumstances that are making them rich, and is equally protected by the will to ignore, exercise, or condemn those who express doubts." Now, I start with that quote for a couple reasons. One is, I have noticed in a lot of mainstream folks, but not just mainstream folks, people on Twitter, investors, some are professional, some are amateur, but there's a lot of complacency right now. And that complacency, I think, is not born of ignorance. If anything, it's quite the opposite. People increasingly know that the economy is not all that strong, or at least it's not what the mainstream claims. They know that we have a national debt crisis. They know that there's political rancor in the country. They know that there are these various geopolitical fault lines that are trending towards hot wars around the globe. They're not stupid, but they have become very complacent. And part of the reason for that is because over the last several years, and you might argue over the last several decades, the stock market has ignored a lot of this, at least on the surface. And we're going to talk more about that in just a second. And so there is a kind of complacency. Furthermore, there is a hardening of two very different interpretations of where we stand, or at least where the economy stands. One group is advocating vociferously that the economy is strong, that it has shown resilience, and in fact, it's picking up in momentum. These are folks that are pointing to the GDP numbers. They are looking at the earnings, the revenues of a lot of these corporations, and they do not perceive any existential or systemic crisis, and therefore they're bullish. And the stock market seems to be a reflection of that. At least that's their view. Then there is the alternative view, and this is my view, and that is that the economy is actually very weak, that there are warning signs galore across the board, and that systemic risks are not just ever present, but that they're actually accelerating, or that they're beginning to manifest from all sources, or from a variety of different sources. How do I square that circle? In other words, the folks that are complacent, in my view, they're not uninformed, they're not ignorant. But how is it that their viewpoint is so radically different from mine? Well, I think part of the way we can explain this comes from the Federal Survey of Consumer Finance. And I want to state at the beginning something I pointed out on this channel a multitude of times. The first is that America is a financial system with an economy. It is not an economy with a financial system. And what I mean by that, just to be very clear, is that the process of financialization, which began in the 70s and has led to a lot of very destructive consequences for the economy, that process is nearly complete. A few data points from the Survey of Consumer Finance. The top 50% of income earners in this country own 94% of the assets. The top 10% own 33% of the assets, and the top 50% do about 85% of the spending. Now, in my view, that goes a long way to explaining why the balance sheets of a lot of these companies, the earnings, the revenues that they're generating, are still pretty strong. It's not because the economy is strong, it's because there's such a divergence. There's such a disparity between the upper income brackets and the lower income brackets. But that disparity is not because the top 50% are so wealthy, it's because they own assets, and those assets have gone up. And they've gone up consistently for several decades. That has created an exaggerated effect or an exaggerated sense of wealth in this country. But if that reverses, because we're just a financial system with an economy instead of the reverse, look out below, because there are going to be major social consequences. And as I've said, I think that's where we're headed. Another data point that reinforces this disparity is that the top 5 richest men in the world, Jeff Bezos, Warren Buffett, Elon Musk, Bernard Arnault, he is a Frenchman who owns the largest luxury goods company in the world, and Larry Ellison, who is the founder of Oracle, their wealth has doubled in the last 3 years. So 3 years ago, they were worth about $400 billion. Today, they're worth almost $900 billion. So why is that? Is that because their companies have doubled in value based on productivity? No, it's because asset prices have risen. All right, so what are the warning signs that this financial system that's at the heart of this disparity and creating this steroid-like effect for a bodybuilder when in fact we're not that strong, we're not that resilient? What are some of the warning signs that are beginning to intensify or at least reflash? Well, the first is bank fragility. And here I just want to make reference to New York Community Bank. So New York Community Bank is one of the top 30 lenders in the country, and 22% of its loans go to rent-controlled apartment complexes in New York City. I mention that because in recent weeks, New York Community Bank has experienced some real financial headwinds. Its stock price has nearly collapsed, and the reason is because it's had 2 very big losses on its balance sheet. One from commercial real estate, which we're going to talk more about in a second, and the other from multi-family housing. There are concerns, murmurings, that there's contagion, that what's happening at New York Community Bank, which is similar to what happened almost a year ago in March of 2023 with Silicon Valley Bank, is systemic, that lots of these small and regional banks are holding very similar assets and that those assets are losing momentum, that they're losing steam, and therefore the banks are beginning to shudder as a result. Well, to calm fears, Treasury Secretary Janet Yellen said the following. She said, "I hope and believe that commercial real estate weakness will not end up being a systemic risk to the banking system. There may be smaller banks that are stressed by these developments." So in other words, the mainstream is claiming that this is localized to the smaller banks. The problem with that, of course, is that a lot of these banks, the smaller banks, are tied to the bigger banks and vice versa. And I think we're going to discover more about just how interconnected they are over the next few months. The result of this hemorrhaging of the stock and these rumors is that Moody's, which is a credit ratings agency, downgraded New York Community Bank's credit rating to junk status. So this is how quickly things can change. Now, one other side note that I think is very important to mention is that New York Community Bank was one of the banks that bought up Signature Bank about a year ago when the banks really started to come apart. Signature Bank, if you recall, was one of the 3. It was Silicon Valley Bank, Signature Bank, and I think the other one was First Republic, that all went bust, okay? Well, New York Community Bank bought up some of the assets on Signature Bank's balance sheet, and so now they're beginning to have trouble as well. So this is a big mess, and it's only going to get worse. And one of the reasons it's going to get worse is because of the rapidity with which contagion can spread. Now, I mentioned in a video that I did way back when at Silicon Valley Bank, when investors or depositors began to realize that it was bankrupt, they withdrew about $1 million per second in a 48-hour period. Well, there was a report, really it was an after-action report put together by the Group of 30. I'll link to this below. And they talked about the increased risk of contagion. So that is that these bank runs could spread, or that banks could collectively start taking on water, that their stock price could collapse because confidence erodes very, very quickly. Well, listen to what they said. A major issue common to all banking systems is that runs will be much faster compared to earlier periods, given the greater ease of withdrawals with more online real-time banking. Contagion will be larger given the spread of information on social media. I think that that's a very apt point, because as the average depositor, as the average investor starts to awaken to just how bankrupt the banking system really is, you're going to start to see more bank runs. So what's happening at New York Community Bank is a warning sign. And remember that as recently as October of last year, unrealized losses, so these are basically assets that banks hold that have depreciated but they haven't been sold yet, okay, reached almost $1 trillion total. And that included some of the big banks like Bank of America, for instance. Well, that's noteworthy because there's only about $20 trillion in assets in the entire US banking system. So having a hole that's about $1 trillion, that's a big problem. So the first warning sign is banking fragility. The second is the refinancing crisis. Now, refinancing is a big deal as interest rates rise. This is a problem that has been a slow motion train wreck. Well, listen to some of these numbers. The US government has to refinance 30% of its debt over the next 18 months. 30%. And remember that the national debt is in excess of $34 trillion, and it's rapidly moving towards $40 trillion. In fact, some people think it's going to hit $40 trillion by the end of this year. That is just an astronomical number. The key, however, is the interest expense on that $40 trillion. So refinancing today, when interest rates have gone from almost zero for the federal government to 5%, that's a 5x from what the cost used to be. So now you're going to start to see the federal government have to spend $1 trillion, maybe $2 trillion, maybe $3, $4, or $5 trillion in any given year just to service its debt. And once you hit those points, that's when you start to see the doom loop, the debt doom loop as they call it. In addition to that refinancing, there's commercial real estate. So we talked about this just a minute ago. Well, guess what? There's $1.5 trillion worth of commercial mortgage debt that has to be refinanced by 2025, okay? So this is a massive problem, and it's not going away. If anything, it's just going to get worse and worse between now and 2025. And as you can see on the screen, the office space delinquencies across the country are enormous, right? Companies are liquidating or they're canceling their leases at a lot of these big buildings in some of these metropolitan areas. Now, a knock-on effect is that it's going to compound the municipal debts that are rapidly accumulating across the United States. And remember that municipal governments, they get a lot of their revenue from commercial real estate. Well, the municipal governments also have to finance the pension funds of the baby boomers. So as you can see, the risks are piling up, and they are absolutely systemic. And it's not clear how we're going to weather this storm. Well, the third risk is the housing market itself. So as you can see on the screen before you, the housing market, this is retail now, not commercial, has actually fallen by almost 13% in 1 year. That is a massive depreciation. That's a housing crisis, okay? And I'll include where I got the data in a tweet below. But this is very important to note. Every single price drop in housing of 2% or more has preceded or coincided with a recession, except in 2018 or 2019. So, in other words, when you get these massive depreciations in retail or in residential housing, that also seems to betoken a recession. And I, for one, think that we're going into a severe recession, probably more like or more akin to a depression. So that's another warning sign. The fourth is that even though the stock market has performed very well, especially since November of last year, there has been a narrowness, a concentration of investment, largely because of what's called passive investing. That's something I'll talk about more in another video. But there has been a narrowness of focus on the big blue chip companies. They call them the Magnificent Seven. You know, there are various names, but these are all the household names that we're familiar with. Microsoft, Tesla, Apple, so forth and so on. Well, listen to some of these data points that are troubling about those companies. Apple, as of 2016, their earnings, so again, the revenue that they generate relative to the S&P 500 has been flat. In other words, they're not growing, but their market capitalization has exploded during that time. And Apple at its peak was about $3 trillion in size. So again, people, investors, institutions, retail, etc., they are just throwing money at a company that has either peaked or is stagnating and, you might say, declining. That's bad news. Microsoft. Now, Microsoft has received a big boom because of ChatGPT and AI and all that mania. But as you can see on the screen before you, Microsoft's market capitalization is now greater than the entire S&P energy sector. Now, that might make sense if Microsoft was generating returns or cash flow that exceeded the S&P energy sector. It's not. So again, lots of money is concentrated very narrowly in just a few companies. And some of those companies are starting to break down, most notably Tesla. And the fundamentals underlying these companies like Apple, they're not great. So that's a warning sign. In other words, it's the speculative mania, folks. We're entering the speculation danger zone. The fifth warning sign that I want to leave you with is that these speculation manias are always driven by some thematic hopium, some mania tied to a specific narrative. And in this case, it's artificial intelligence. A couple years ago, it was crypto. Crypto we'll talk about more in a separate video. But AI, however productive it may be, and I'm going to include a paper in the link below that raises some questions about it, because at this stage, it's still very speculative what in fact it's going to do. But it's, according to Wall Street, going to produce a productivity miracle. Now, I quibble with that. I don't necessarily think that that's the case. And remember that over the last 20 or 30 years, we have been promised a number of productivity miracles. The internet itself was supposed to be one. But there's a paper that I talked about in a recent video written by an economist named Robert Gordon, and he looked at the innovation in the United States since the 1980s. And guess what? We just haven't been very innovative, okay? So is AI going to be different? I don't have a whole lot of confidence that it will, regardless of how productive it will be. However, is it enough to compensate for the housing crisis in the residential market? Is it enough to compensate for the commercial real estate refinancing or the government debt that's rapidly accumulating? I don't think so. And that's really the issue. So we're entering into, I think, the blow off top, the last stages of a mania that's going to end very badly. And ultimately, it's going to impoverish those upper 50% income earners that are responsible for doing all the consumption that's keeping our companies afloat. So if you follow what I'm saying, folks, this is it. We're now, I think, in the final stages of this. That's not to say it's going to end tomorrow or even in 6 months. It is to say, and this is not financial advice, hopefully it's financial insight, be very careful with your investments right now. Be very keen, pay attention. And if you do have some profits, consider taking them and getting out of the market. These things always end the same way. A massive euphoric bubble that can't possibly end, guaranteed by some new technology or story or narrative that's going to make all of our dreams come true. All those telltale signs are there. The warning signs are percolating. They're bubbling to the surface. Pay attention to them and be safe. Stay tuned for more, and we'll talk soon.